All right, welcome everyone to our Colorado Real Estate Investing 101 class. So Karin and I are going to do you want to do your intro first?
Sure, I can do my intro first.
Okay.
So yay, thank you all for coming. I'm excited to see this turn out. We have great guest speakers tonight, which we'll introduce in just a second. But Amy and I started these classes a year ago now. We're into our second year, so that's exciting. And the reason we started them was because we met at one of the quarterly meetings and just realized we shared this passion for real estate investing. And so just real quick, I'll tell you how my passion started. In 2015, I was basically a stay-at-home mom, and my husband's a teacher, and we have 4 kids, and we were just kind of barely scraping by every month. And so we just started learning a little bit about real estate, and then we started learning more about investing, read Rich Dad, Poor Dad, and we made our first real estate investment, and it just created so many options for us, changed our life, and that's where my passion started.
All right. And Karin told me I only had 2 minutes, and she's like, "Are you sure you can only do this in 2 minutes?" So I worked hard to get this down in 2 minutes, so bear with me. So many years ago, I was born in Manhattan, Kansas. We call it the Little Apple. So my parents, when I was born, were 22 years old, and I have 2 older brothers. So without a high school diploma and 3 kids, we didn't have all the fancy vacations. But what we did have was a lot of happiness and a house. So when I was really little, my parents bought their first home. It was really small. Luckily, I got my own room, but my brothers had to share. And so many trade-up homes later, my parents now have equity in their home that's providing them options for their retirement. And then I also have what's driving this is also my husband's family. So they're also from what we call Manhappiness. They started out low income and young as well, but they had a different journey. So my father-in-law became a home builder. And so when my husband was 21, he said, "Son, here's the deed to your first duplex and the mortgage." So he was a real estate investor at the age of 21. And then we moved out to Colorado together and started our fun W-2 jobs. As we climbed the ladder, my father-in-law again encouraged us, you need to buy in real estate, you need to buy in real estate. So we did. And then we had kids, and then it got crazy. Like, oh my gosh, the kids go to school for half a day, and we both have these really, busy jobs that we need to be there. So real estate investing, what it gave to us was an option. So I had the option to leave my corporate job and find something else that would fit with our schedules. And so at first I was going to be a professional investor. So I was like, we can do this. We'll like double our investments. But then I was like, well, this is not that fun because I can't talk to people. So what I was like, oh, what would be way more fun if I could help other people do what we did, but do it smarter and do it quicker and do it bigger. So I joined Berkshire Hathaway in 2019 and quickly met Karin, and we shared our passion for helping others and educating others. So like she said, we started this class a year ago, and here we are doing the dream job. So we're both super passionate. We're super passionate about always learning. And so for that, we're going to bring in lots of special guests this year. If you guys don't have the calendar of all of our classes this year, we have a copy up here you can take home. And we are going to, you want to present these guys and we'll hand over.
So I want to introduce you to our special guest. So Will Allen has been a friend of ours, my husband and I, for over 20 years. Yeah, so I can personally speak for his character and just a great friend and a great person. And he is a financial advisor with Cedrus. and his business partner, Brandon. And so we'll pass you guys the mic and let you take it away. And thanks so much for coming.
This is like official. I love it. Does this make me look important?
You are important. So as Karin mentioned, I'm Will Allen. I have been in financial planning now for 16 years. Right out of college, went to school at Indiana University, had a desire to live near the mountains, new bride. We packed the 10-foot Penske and we moved to Colorado. Naturally, out of college, you have to find a job. So I deposited my checks at First Bank and worked there for a few years. And I've now been in the financial planning arena for 16 years. I do carry my certified financial planning designation. Brandon and I work together at Cedrus down in Littleton, where we just help families with regards to planning. We're not kind of your typical financial advisor that works out of the box of stocks and bonds. We really do believe that real estate is an important part of a client's overall portfolio. Brandon?
So I didn't come from such a financial background. I grew up on a farm in Minnesota, went to school in Oklahoma, came to Colorado. Same thing for the mountains because I love snowboarding. And I had a 15-year career in a completely different industry. But COVID happened, right? A lot of people had to shift. And I absolutely loved my previous career, but it forced me to shift into something different. When you get laid off and you need a job, you got to, kind of reinvent yourself. So thankfully, a friend of ours who's the CEO of Cedrus approached me and said, "Hey, come and work in this, financial planning world," which was not what I was planning on doing. I was building this business plan to become I love golfing. So I was going to be an indoor golf simulator owner. So I don't know if you guys have ever heard of X Golf, or essentially like Top Golf, but inside. So how many of you guys have been to Top Golf? Well, most everybody's been to Top Golf. So, hitting balls into a screen versus out there into a big hole, right? But, things happen. Life is not exactly what you think it's going to be. So this career shift happened to where, he really convinced me, because I had this idea of financial advisors. And I don't know if you guys have ever met one, worked with one. There's some good ones out there, but then there's a lot of what I would call so-so ones and a lot of bad ones. And I say this because I don't come from that industry necessarily. So I've been doing this for about 3 years now. And I love what Amy said about loving your job. Like, this is a passion of mine. I've always liked finances, but never applied it to like making a career of it. And I love it because of how Cedrus approaches it, which is walking life with all of our clients. And they don't become a number, they become family, and walking through all the different decisions that they make. And real estate can be a really big, powerful part of that. So as far as what we do, like, we do holistic financial planning. That includes estate planning, like wills and trusts and all that type of stuff. Leaving a legacy for, either your kids or somebody else. We do tax management. We're not CPAs, we're not estate attorneys, but we can work in those realms and look at things further down the road than most of them will look. A CPA is really good at doing your taxes this year, but they may not give you advice of what taxes are going to look like 20 years from now, right? And the decisions that you make right now. So besides investing, retirement planning, real estate is a part of it, education planning. Almost everybody that's a parent is like, how am I going to pay for college? And what's the best way of going about doing that? So holistic, our biggest niche is probably families, a lot of high net worth families that have small businesses. Sometimes the small businesses is a real estate empire that they're building. And then we do a lot of work for nonprofit organizations, also for a bunch of churches and ministerial work. And am I forgetting anybody?
No.
pretty much anybody that really needs some advice. So with that, I'm going to hopefully do this right. Next. Okay.
So
There we
what we're
go.
going to talk about today is 3 different things. We're going to talk about real estate from a financial planning perspective. We're going to talk about whether or not determining potential real estate purchase is a good investment or not. And then finally, we're going to briefly touch on the topic of retirement planning.
So there's several things that we look at as far as real estate investing goes. Oh, sorry. Real estate investing goes. Can I actually stand back here? And does that work? And I'll do this so you can see me. All right. So real estate can be a really good investment, but you have to kind of weed out what makes it good and what makes it not good. And real estate can be a great hedge against inflation. Where inflation, we're in a high inflationary market right now. A lot of people may have grown up and never really heard about inflation a whole lot because it was so low for so long. But we're in a high inflation market environment, and real estate can be a really great hedge against that because real estate is, typically appreciating over time and sometimes not in sequence with inflation. The power of leverage, when you take out a mortgage, you're leveraging your money. And we'll talk about that. Efficient, inefficient market. The stock market works in an efficient market. Real estate can work in an inefficient market. We'll talk about that a little bit. And then tax efficiencies and 1031 exchanges, stuff that you may or may not know. A hedge against inflation, there's the nice thing about a property is that, especially if you find it in the right place, and it's all about location and demographics and all that type of stuff that a lot of you guys know about, is the appreciation of it. And you can buy real estate in 2 different modes. Most of it we're going to talk about is in the residential space, not the commercial space. But you can either buy it for cash flow or combination of cash flow and appreciation, right? And homes have appreciated greatly over the last 100 years, right? And it's been a great investment, even if you have never bought or sold or bought it a long time ago and just held it for the last 50 years, right? Anybody that bought a home, back when homes were selling for 10 grand, were like, oh my goodness, I can't believe my home's worth $500,000 or $1 million. And then, fast forward another 20 years, that $1 million home, people are going to say, I can't believe it's worth $6 million or however much it's going to be because everything is going to inflate. So there's a couple of things. Inflation does help drive home values up, which we've seen a lot of recently. But homes tend to hold that value a little bit better when inflation is high too. And the rest of the market seems to be crashing. So a little bit of a hedge against inflation.
So what I'm going to talk about is the idea of the power of leverage. Basically, if you take, like, let's say you buy a $500,000 home and you're getting a 5% appreciation. You basically take that 500,000 divided by 5%, you come up with 25 grand. You take that 25 grand, you divide it by your 500,000, you in essence have a 5% cap rate. So when it comes to 20% down, like if you put $100,000 down on a $500,000 property, basically you have 5x, so 5 times your borrowing costs on that, which is one idea when it comes to the overall idea of leverage. Are you all familiar with the concept of arbitrage? Anybody that's not real estate. So the idea of arbitrage is basically, for instance, you open up a bank account. Your bank account would offer to pay you, like, let's say a 0.01% if you're lucky with regards to your earnings on that money that you put into your savings account. The bank turns around and they're going to, in essence, loan that off like through a car loan or through a mortgage or something like that. And they're basically going to be charging a new customer 5-6%. So they're in essence getting 5% off the money that you're ultimately getting out. So the idea with arbitrage is you really experienced it a lot with lower interest rates. Like when we were in like a low interest rate environment and it was like 3.5% to purchase a new home, basically you could go out and buy that home, pay 3.5%, and then you could in essence go out and invest that into like another investment earning 8-9%. So the whole idea of arbitrage is you could get 5.5% in terms of return on your investment.
Yeah, and the leverage piece, I mean, to only put, when you're buying a home, you only put 20% down on it, and it's $1 million home, you put $200,000 down, you have $1 million home at your disposal that you're living in, and that you're paying off of. So you can leverage that, and then as your equity grows in there, you can always scrape away some of that equity and purchase another home at 20% interest and grow. And that's really how people start growing their portfolio, is by taking a little bit of capital and deploying it into a lot more capital, right? A lot of value. So,
Like in stocks, for example, you put in 100,000, you're only making a return on that 200,000. But if you put 200,000 in a home, you're making a return on that 1 million.
yes.
Yep, exactly.
Yeah. Yeah. When the home appreciates, it doesn't appreciate on that 200,000. It appreciates on the $1 million, right?
Yeah.
And you guys have seen appreciation in homes here recently, be double digits. And that's double digits on the entire home, not just a portion of it. So, yeah.
And it's become challenging, especially amidst the high interest rate environment that we're in, where borrowing costs are now at 7%. Basically, the whole idea of the 2% rule is you, in essence, have to go out and make 9% on your investment in order to have kind of that break-even point. So we saw a lot of kind of the idea of arbitrage back in the day when we had kind of the low 3 to 4% borrowing costs.
Well, and that's the thing, is even if you had $1 million in cash, you wouldn't want to sink it all into a house. You want to leverage even the cash part of it, because you want to take a loan on that $800,000 and not pay on it, because that $800,000 you can go and reinvest that, whether it be the market or something else, go get 7-8%, and you're kind of leveraging all your assets in multiple different ways.
So here is just cap rate. Cap rate basically excludes your borrowing costs.
Has anybody heard of cap rate? Okay.
Can anybody define it outside of Amy? Okay. So cap rate basically takes into account your net operating income as a percentage, and then you divide it in essence by your property value. So let's say, for instance, when we talk about your overall kind of net operating income, we're in essence taking into account your total gross rents. So if you're charging, let's call it $2,500 a month, that's $30,000 over the course of the year. And then you're in essence subtracting away your maintenance. So let's say you have $5,000 worth of maintenance costs. You take $30,000, you subtract away $5,000, you come up with $25,000. And then let's say your property value is $500,000. Your cap rate in that case would be 5%, kind of circling back to my initial example. So that's going to help us determine, am I in fact buying the correct or right property? Return on equity, on the other hand, that really does take into account your overall equity within the property. So it does take into account your overall kind of borrowing costs. So how we calculate that, and we'll have an example in the next slide if you want to go ahead and fast forward. Here, you can see with your cap rate, the $33,000, that's kind of our gross rent that we're coming that we're collecting year over year, subtracting away the $5,000 worth of maintenance costs, you come up with 28,000. Dividing it by the property value of 500 grand gives you a 5.6% cap rate. Then return on equity, on the other hand, this really does take into account kind of the overall equity that you have within the home. So you're looking at your principal paid. So in this example, you have $7,138. You're taking into account kind of the net cash flow. The net cash flow just in essence refers to, am I actually making money year over year on this particular property? In this case, you're making $5,084. So you take those two numbers and you divide it by, in this particular case, we put 100 grand down. So we have a 12.22% return on our equity. Does that make sense?
So who here owns a property? Who here would like to own a property? Everybody. Who owns just the primary? Who owns investment property? So a good mix of everybody. And I think it's proves the fact that anybody that doesn't own property would like to own property. It's kind of that American dream, right? Owning property, owning a home. And then you start owning a home and people introduce you to the idea of, well, you can own multiple homes. And we'll actually talk a little bit about short-term rentals here a little bit later. But, well, what if you owned a vacation home and you rent it out and it cash flows as well, right? All those things. One of the things that make rental properties more efficient is on taxes. Who knows about depreciation? Who's never heard of depreciation? So, and again, could anybody talk about depreciation within rental homes and how that works? Also, we can send the slides out if you don't want to take a picture of all of them. Okay, well, let's see if somebody. Yeah. How do you properly depreciate an income property?
I take my statements, I send them to my CPA.
There you go.
Great answer. Great answer.
As long as I've been in this business, I don't know if I can explain it good, except that
somehow your tax liability becomes less, right?
And when I bought a lot of rentals, back in the day, I didn't feel bad if I was breaking even on them because I was depreciating. Depreciating it off my income, and even if I lost a little bit, I was writing off the loss off my income. But I don't know how to explain depreciation. Brenton would have to do that, right? My CPA is all that.
And it's different in the commercial real estate world.
It is.
Yeah.
We deal a lot with accelerated depreciation. And I don't know. Do you depreciate
Rental properties is flatline depreciation.
20 years?
So 27 and a half years.
Okay.
If it's commercial
Yeah.
property, it's
0.5, isn't it?
Okay.
Yeah, 27.5 years.
I just know when I sold a couple that I didn't realize I was going to get hammered by recapturing.
Right.
So
not to sell anything anymore except if I'm doing a 1031.
I mean, who likes paying more taxes than they? You like paying more taxes? All right, that's the first time I've ever heard that.
Yeah, right.
All right, everybody wants to pay less taxes, right? So, I mean, an income property is a great way to start doing that, paying less taxes than what you would think you would owe. Because in an example, we purchased a $500,000 home. We put $100,000 down. The home, now you have to depends on your CPA how legit they are. You're supposed to separate out the building from the land. So let's say the home is worth $450,000. The land's worth $50,000. You take the $450,000 home and you divide it by 27 and a half. And that is the amount that you can depreciate, take off of your taxes year over year for 27 and a half years, right? So and it turns out to be like 3.636% a year that you get to literally write off of your taxes. You also get to write off a lot of other things, maintenance, and there's a whole host of things that you can deduct from your taxes when you own a home. So in
an easier number on 100,000, then you can appreciate 3,700 ish.
Yeah.
You said 3 point
Yeah.
something.
3.636%. Yeah.
Okay.
Yeah.
A year for 27.
Yeah. So
Yeah.
I mean, multiples of that in $100,000 increments. Yeah. But yeah, it's supposed to be just the building value and not the building land. So depends on your CPA how they do that.
Technically, there's not. So I am a CPA, I'm a practicing CPA. So I'll preface that, but there's not a set way for you to say land versus building. So as long as you can prove that you did some judgment between what part is land and what part is building, and so most people take their property tax assessment. That's the best way to do it. And you then take whatever that ratio of what they put on your tax assessment is land
Land is always so low.
and use that percentage times what you purchased of that. That's the easy way to do it. If you're trying to use TurboTax and do your own taxes, that's the way to do it.
Yeah.
Yeah, and that's why we kind of always defer to whatever your CPA says, since we're not taxed.
CPA coming with a plug for April meeting, so come get all of your real estate. She's also a real estate as well, so she'll be great.
So, I mean, just as far as a quick example, if you're getting a gross rent of $2,750, you're paying taxes, insurance, maintenance of $5,000. Your net operating income is $28,000. Normally, you'd say, "Well, I got to pay taxes on $28,000." Well, no, because you get to be able to depreciate again that 27.5 number on the purchase price of your home. In this case, since you're borrowing $400,000, that's the real value that you get to start depreciating is the borrowed value, right? So you divide that out, and it's $14,547 a year, and that brings your total tax liability from $28,000 that year to $13,455. So hopefully that makes sense. Essentially, you save money on taxes.
Yeah.
That's
So
the
you're
biggest
getting
thing.
28,000, but you're only paying taxes.
Exactly. So, and as much as you can depreciate, and you can depreciate a lot of other things, including, upgrades to the home, those type of things. So, but it's one of those things, as you depreciate the value of depreciate that loan that you took, the cost basis of the loan does depreciate over time. So there's not like a kind of a free get out of jail card with taxes. So every time you defer $14,545, and every year that number is going to be different, eventually your cost base of the home is not going to be $400,000 anymore. And cost basis is really important when you sell your home, right? So that $400,000 eventually is going to go down to zero. So essentially it said you own all of that home, and as soon as you sell that home, you don't get to use a $400,000 cost basis. And let's say the home, doubled in value to $1 million. You're going to sell $1 million home and owe taxes on $1 million. So that's where, if you sell it, that's where 1031 exchanges, all that stuff gets to be really popular. And it's a question that sometimes, we have to ask people when they want to get into it is, well, is this a short-term kind of project that you want to do, or is it kind of a lifestyle project? Because rentals, investment properties really get to be way more tax efficient when it becomes a long-term, like multi-generational legacy type play. Because again, it's all about taxes. Even though you depreciated that $400,000 to nothing and the house is worth $1 million, once you pass it on to your heirs, they get a step up in cost basis, right? And then they get to depreciate that home down. over time. So again, and that's where we love having these conversations of your like people specific projects and what they want to do, because it becomes a lot more than just investment property. It can be a legacy conversation as well.
So I'd love to talk to you guys. 2 years ago, my wife and I, my wife is just a constant avid like shopper looking for mountain homes, things of that nature. And I said, I'm only going to get a mountain home if we can get some cash flow potential off of it. She was kind of always looking off in like the boonies, and I'm like, well, that's not really popular when it comes to. I'm a financial guy, so I want to constantly be seeing kind of a return on my investment. And so finally, we came to the agreement that we're going to buy a cabin in Granby. And it was a great investment for us, as opposed to just looking at long term. I also wanted to kind of introduce the whole idea of short term rentals to you guys as well. So we bought a property in Granby. So I always encourage, if you're looking at the short term rental market space, look at your location. Location. That's key to having success within kind of the real estate investment world. And then also look at your cash flow potential. So we chose Granby over Grand Lake because we felt like the location was great for skiing between Winter Park. There's Ski Granby kind of right in our backyard. So we just really chose a location that had good cash flow potential. We worked with a realtor up in the area who was able to kind of give us kind of an inside scoop in terms of, hey, this is a popular area. You always want to make sure that before you buy a property that there's no kind of like moratorium against short-term rentals, because that would be a bummer if you're like, hey, I'm going to go buy a mountain home and generate all this cash, and then like your HOA is like, nope, can't do that. So always look at the cash flow potential. And then finally, the big piece of mind for me was hiring a management company. Management companies are key, especially if you're in Granby. You have a lot of turnover with regards to our management company handles like everything. It's like pretty much white glove service. They handle the bookings, they handle the renter complaints, they handle the coordinating of cleaners. We're up in Grand County, and it is a nightmare finding cleaners up there. So having kind of a management company that has a monopoly on the cleaning crew was key to us, just giving us kind of the peace of mind in terms of like having that good cash flow potential.
So and short-term rentals, the cash flow model is so much different than long-term rentals,
Definitely.
right? There's peak seasons, there's lulls. You're just looking at utilization, that kind of stuff. But I mean, yeah, I mean, I know some people that just even through the few peak seasons that there are, they almost essentially cash flow their home, plus the fact that you get to use it.
Yeah.
Right. So there's more than one way to look at rentals. Obviously, a lot of it that we look at is probably longer term rentals, but short term rentals work as well. Questions? Anybody? Any questions so far? If not, I'll go over one thing that we get a lot from our clients that come in when they're looking at getting into the investment real estate home. Most everybody has a home, you know, their primary residence, and they've lived in it for 15 years. It's appreciated a lot. They have a lot of equity in it. And a lot of them will come to us and say, well, why don't I just buy a new home and then start using my old home as a rental? How many think that that's a good idea or bad idea? Good idea?
I did it twice.
Was it a good idea?
It was amazing.
Okay. I would say, I mean, there's good ways of doing it, bad ways of, not as good ways of doing it. But in a lot of cases, what we've seen is they bought a home that they've had for a long time, had a lot of appreciation and equity of it, and the downside of turning it like a primary home straight into a rental is, again, all about taxes. Everything is really about taxes, and it's about free capital gains, right? What does a primary property give you as far as free capital gains?
Anybody know?
Real estate people.
You
So
sell your home, you're gonna pay the capital gains up to
if you've lived in it, what?
3 years.
2 out of the last 5 years.
Yeah, 2 years.
Yeah. So if you lived in your primary home for 2 out of the last 5 years, you can sell your home and get essentially, $250,000 per person if you're a married couple, $500,000 in free capital gains.
Exactly.
Right? So it's all about paying no taxes or as little taxes as possible. So in most cases with somebody that is even, breached that limit or within those limits, we're going to probably educate them on, let's go get free capital gains first and then turn around that and put it towards investment real estate, leverage that money. So everything, when you come talk to us about, really anything, we're going to talk about taxes a lot.
Because it also affects depreciation, right? So like what you can depreciate is based on
The original,
when you bought it.
exactly.
So if it appreciates, I learned this the hard way because I did that, and I was like, oh, that.
So I mean,
Yeah.
and there's situations where it may make great sense, especially if you haven't lived in there very long and has appreciated very much, or if you're in a period where it's kind of upside down and you want to get into a different place. That it does work, but we like to look at it from a case by case perspective, and just look at it and say, well, it makes sense, not make sense, along those lines. So, not to belabor that point, but again, we like to say, again, example of a $500,000 home, $400,000 borrowed against it, you can depreciate $400,000. That's great. If it's $1 million, well, you got that $1 million completely free and clear. If you're a married couple, if you're single, you got to pay taxes on $250,000 worth. But you get that free $1 million. You go buy a primary property that you're going to live in with part of that asset. The rest of it, you can say, well, let's go buy investment property, leverage that. Let's say you put 200 of the million that you got, and so you leverage that into another $1 million home. Now you get to depreciate $800,000. So everything essentially becomes a tax game. And we're going to talk a little bit about investing, but one of the things that almost makes a bigger impact on net worth over time is taxes and how to play the tax game. So, there's a million things we can do with taxes. Do you guys know, besides real estate, because we always have real estate as kind of one piece of the puzzle in retirement planning or financial modeling. Do you guys know of do you guys know about taxable, tax deferred, and tax-free buckets of money? So what's a tax-free bucket of money?
Yep.
So what we call tax-free is really like the Roth type buckets of money where you pay taxes going into a retirement plan and it grows tax-free and you can take it out tax-free. Then there's tax deferred. Has anybody ever been in a 401k plan? Or anything along that? SEP plan, simple IRAs, all that type of stuff, or even just invested in IRAs. So Roth, 401ks, Roth, IRAs are the same. You pay taxes going in, it grows tax-free, you get to take it out tax-free. 401ks, IRAs, you don't pay taxes going in. Yay, you don't pay taxes going in. It grows tax deferred, and then you pay taxes when you take it out, right? That's 2 of them. And then taxable, those are like your investment accounts, your E-Trade account that you have that you like to go trade cryptocurrency in, right? Who does that? No one? Wow.
Not a single crypto investor. Wow.
So
I have some Doge.
okay, see, okay, we finally got one. There's at least a few within every group that we. Oh yeah, that's. I mean, they all the dog name ones, right? So Yeah.
I'm up $3.41.
You're
So-
ready for retirement.
Yeah.
Yeah.
So
But
tax.
I did buy Tesla at 112, and it's up to 200 and something.
There you go.
Look at that.
I'm happy about Tesla. Shiba's like, if I put $100 in it, it goes to $1 billion. I'm good. I don't know anything about it, so I don't do it.
So again, for us, I mean, from a investment side, it's all about managing tax buckets, and there's lots of different tax buckets, and those are the major ones on the retirement side. But you know, one of the things that we would say most financial advisors don't do is actually do a lot of modeling with their clients on, you know, where they're at now and seeing investment decisions, whether it be purchasing a home, whether it be funding kids' education, whether it be, you know, taking a trip around the world. All these decisions have impacts, lifelong impacts on money. And the thing that we like to do is to be able to model that in front of you to where you say, hey, let's put an input in and see how that decision affects money, not only now, but in retirement and beyond. And then we get to weigh out all the different decisions and say, hey, let's let the models kind of help us dictate what makes a good investment and not. And we also do that within real estate. We have a bunch of real estate spreadsheets that will plug a lot of this information, talk about cap rates. We don't have to really calculate it, put it in a spreadsheet. It spits it out, say, hey, does it make sense to buy this property or not? And the nice thing about you guys in an inefficient, what we call real estate, an inefficient market, anybody that is in real estate, is you guys really know where the niches are. So even though interest rates are really high right now, and would say a lot of real estate investment is not necessarily the most advantageous or lucrative right now, like you guys can go find the deal that no one else can. So whether it be somebody that has to sell their home because of one thing or another, and they sell it at a massive discount, which outweighs those big, you know, disparities within interest rates, that type of stuff. So you guys work in a kind of a niche market where even where it's bad for the normal person to go purchase a home, you guys can go find the right deals. So. And I think that's it.